Yo, what's up, everybody? So, this is another part to episode one. In this episode, we're going to talk about banking systems and how the banks trade, and we'll dive in a little bit and just see what's going on. So, I want to start off with how do they trade? Or actually, let's have a look at the players. So, the let's talk about forex, indices, futures, and commodities. Now, a lot of people don't know what a future is. They'll say, "Oh, I'm a futures trader." They'll put it in their YouTube bio. I'm a futures trader. Okay, you don't know what a future is, mate. Pipe down. So let's have a look at a thing called the Big Four and the Big Five. These are the four biggest banks, and each country has them. I believe countries like Singapore have three. Places like Switzerland have three. Taiwan has five. I believe the Philippines have five as well. Different countries have different amounts, but it's mainly four that we're interested in. England and Wales is Barclays, HSBC, Lloyd's Banking Group, and NatWest. And in America, we've got JP Morgan, Wells Fargo, Citigroup, and Bank of America. These are the kind of main ones, right? Now, these big four control 50% of the volume. Now, the other smaller banks control around about a total with the other banks of about 70%, and then institutions make the rest up other than 10%, which is not retail. The other 10%, I'll get to in a minute. So, mainly, you got your 70%, which is major banks, the big interbank network, and a small interbank network. The interbank network is also how ATMs work and stuff. It's banks being able to talk to each other, but they're also market participants as well, because there's all these other banks operating on these networks as well. So at the top, we've got major banks. Next, we've got big interbanks. Next, we've got small interbanks. Then we've got medium and small banks. And this is equaling a total of 70%, right? And then you got 20% making up as institutional spectators. Spectators are people that trade on fluctuations of price. Then you've got hedgers, institutions, as in like normal institutions. Then you've got people like ETFs, funds, pension funds, this. Got all these smaller participants making up 90%. Then that 90%, the last 10% is split into retail traders, retail ECN, and retail market makers. Now, retail market makers are like your big players. These are guys that have a lot of buying power. Now, I don't believe these make up the 10%. The statistics say that, but I don't believe that. I believe it's much less. I believe the banks were not 99% of the market, like pretty much all of it. Um, okay, sorry, I'll rephrase that. Let's include everybody else but retail. So the retail market makers, retail ECN, institutional spectators, hedgers, all the others except for us, small retail, right? They're moving like easily 95 to 99% easily. I mean, you could get a million people buy a currency and it wouldn't move. You need a lot of capital to move currency markets. Futures is even more crazier. You know what I mean? Absolute crazy. So let's have a look at the um 1 second. So that's it. We're going to look at the daily volume is 6.6 trillion, and that was in 2009. It's probably about 7 trillion now, and that's in the currency markets, and that includes a couple of indices as well within that statistic. It's probably even more than that actually now, because groups have just got bigger, haven't they? Banks have got bigger. The rich have got richer, I mean, it was 5.1 trillion in 2016, so they reckon it goes up every 2-3 years, another quadrillion. So that's just fucking crazy. That's absolutely crazy. Um, Jesus, you just don't know what to say to that. It's crazy. I mean, the futures and indices market goes over 170 different countries. You know what I mean? And the USD is on one side of 88% of all forex trades. That is massive. And only seven currency pairs make up 70% of the market's volume. And also, while we're here, female forex traders tend to outperform males by 1.8%. And 50% of retail traders use MT4 and MT5. Very interesting that is as well. And since 2009, over 10,000 different cryptocurrencies have been released. That is a lot of cryptocurrencies. It's probably even more than that, to be fair. So, how much is the Forex market worth today? The Forex market worth today is worth $2.4 quadrillion. That is a lot of money. That is a lot of money. You got to take that in for a minute. That is a lot of money, isn't it? That is a lot of money being moved. So it's rich people moving their own money. That's what it is, really. And who are the largest financial centers? London, New York, Singapore. Right? People think it'd be other countries for that last one, but it's not. It's Singapore. That's where you got HSBC. Hong Kong and Singapore, I believe it is. So who are the biggest players? So the 10 biggest players from the top to the bottom. It's going to give you a bit of a shocker right now, right? The largest forex trading center, UK, 43.1%. This is why the London session, in my opinion, is very much more liquid. The crossover is the best. For me, I love it. Then we got United States, 16.5%, Singapore, 7.6%, Hong Kong, 7.6%, Japan, 4.5%, Switzerland, 3.3%, France, 2%, China, 1.6%, Germany, 1.5%, Australia, 1.4%. Now, that must have shocked some of you guys because I believed it was going to be the United States when I first looked into that. So that was very, very interesting for myself. So what are the major currency pairs? So actually, let's do the major indices first. So indices is Dow Jones, Nasdaq, S&P, and I'm not on about the size. I'm on about for volume. And that's just the US ones. I don't have the figures for the UK and the Europe ones actually, so I might get them for the next one. But yeah, that is the order of volume traded on them. I believe actually it might go in the same order for the size as well. I might be wrong, so. But anyway, and the seventh major currency pairs is United States dollar against the euro, the US dollar against the Japanese yen, US dollar against the Great British pound. Finally, we in third, United States dollar, Australian dollar, United States dollar, Canadian dollar, United States dollar, Chinese yuan, United States dollar, Swiss franc. Now the top two, United States dollar, euro, 24%, and the next one, United States dollar, Japanese yen, 17.8%. So these are the biggest currency pairs. I'm going to screenshot that and pop that on my Instagram story. That's quite interesting, that is as well, because you got, what is the best pair for us to trade then? The Dow, right? Might sound like the biggest, but it's crazy. It's a beast, right? It's an absolute beast. So does that mean EU would be the best forex pair to trade? I believe not. Go for the top one once you've mastered trading. I believe the best one to do is the next one down, the one that's going to be good to prep you for the biggest one. So in my opinion, the best thing to do is USD, Great British Pound, and Japanese yen. Work up to the big one. Those two are 9 and 17%. EU's 24%. So I think it's best to not do the craziest one. But it depends your style of trading, I guess. Because if you've learned and you've got a very, very, very precise way of trading, you could trade any pair. But I'm trying to cater for everybody because I know a lot of people don't study what everybody else studies, and I know some people studies what everybody else studies. You know what I mean? So get these things for everybody. So I think a lot of people and traders should actually change their trading and use your brain, for fuck's sake. Use the easiest thing. The easiest thing to trade. I don't get why I see traders struggling to learn to trade the Dow. The Dow's crazy. I'll leave the Dow alone. I can trade it, right, but I'll leave it alone. The opportunities are more crazy. Setups get violated more. It's just absolutely crazy thing to trade. Just traders don't use their brain when it comes to certain things like this. It's just crazy. Absolutely crazy. So we learned that 88% of Forex trades include the United States dollar. How crazy is that? 88%. So the US is one of the biggest currencies there. But at the same time, the over-the-counter Forex turnover, the UK comes in. So the UK trades kind of more than US. We've probably got it at I don't know. Our method's locked off more, but that's why London's the best, you know. And London likes to trade the United States dollar pairs. The London session will pop off things like EU, GPD, USD. You can get some really good trades on those. USD, JPY, um, CAD, JPY as well. It's quite a good one. Euro, JPY. Yeah, let's already say that. But yeah, you can get some really, really, really good trades and setups and volume and movements on there. So that's the different currencies and players. Now let's look into execution. So how did the banks execute their orders? So the banks execute their orders by a guy sitting by his desk, looking at a trend line and pressing buy and sell. I'm obviously joking. That doesn't happen. Trend lines are not real. They're something that you see in hindsight. And if you think that I'm wrong, well, I think if you don't even, if you're a trader and you don't even think to question that, well, I think you're stupid. Like, you think the banks are sitting there clicking trend lines. They're obviously not. They don't even look at those kind of charts. They don't care. And it's a misconception that the banks only trade on monthly and weekly and yearly. They don't. The banks trade on everything. They trade on down to the tick chart. We just don't have the infrastructure to trade on the tick chart with them. We don't have high frequency trading machines, which you need a lot of processing power for these machines. It's not like a Bitcoin miner that you can order off the internet. This is a serious bit of kit that they use. Um, so what do? They use computers to trade. I won't go into it too much. I can go into a lot of detail if people want that. I do have the research, and like I said, this stuff isn't easy to find stuff. You can find the jib and jab online about certain things, but I've got actually really good information on some examples of programs and stuff like that. But it's not really going to help you trading, is it? So this high performance supercomputer, gigabit massive fucking things, yeah, absolutely massive fucking processing power on these machines, you know what I mean? And these don't have that gut feeling that we do. These trade like that. You see that thing? They take it, take it, take it, take it, take it. Everything's predefined in it. The risk, the lots, everything that they're doing, right? And it's just constantly algo on algo. Bam, 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 bam. Right? No messing around. That's how they do it. Trading like a computer. So what do you think that brings to the market? That brings harmonic patterns within the market. Within this chaos, there is a certain harmony. Obviously, because it's computers that are trading. So how can we use it to our advantage? We follow the computers. How do you follow the computers? You look for patterns in the market for when the banks and institutions are in. Very simple. And that's what people fail to get. They want to mess around with indicators. They want to mess around with drawing shit on their charts. It's pointless. If you want to do that and manage your risk and all that shit, that's fine. Like I said before, if you're there, you have to manage your risk that much. Yeah, I think your strategy's pants completely because, like I said, it's simple as this. Risk needs to be defined, right? And it needs to be accepted. That's it. If you accept it and you define it, there's no need to manage it as people make it. Obviously, you've got to manage your risk, but people make it. You've got to be there. Risk, risk, risk. Manage, 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 manage. I think it's just crazy. I think you just need to accept it and trade like a computer. You see a setup, you execute flawlessly without messing around. You got your analysis. You know that this trade, yeah, is low probability. So if the trade's low probability, right, what do you need to do? Lower your lot size. Go into low probability mode, just like the computer would. It would switch into low probability mode and take its profit quicker. Stop at break even, leave it to run. Now the computer's got a high probability trade. What's it gonna do? Stop at break even. Take a trade. Take partials. Squeeze the trade a bit longer till it pulls back. Move the stop to break even, but also follow stops down and add on orders. It's going to add, isn't, aren't they? They're going to buy more as the market's giving them those opportunities because they're only following one big bank that's putting their order in. And this bank, yeah, probably talk to the next bank and say, yo, we're dumping 1 million shares. And we'll say, we'll give it to you. We'll give you that liquidity direct. So bam, they did the deal. Private pool of liquidity. These guys, they work together, obviously. So we need to follow them. That's all you need to do is learn to follow them. And if you like indices, you can still follow them on indices. You just need to know where the volume is. A big candle doesn't mean a load of volume. There's no volume in it. only retail volume. You don't need a million buyers to push price up. You just need one seller. Or you can have a million sellers and one buyer. Price will still move up the same. People don't understand this because we're taught wrong. We're taught all this shit. And the thing is with traders, the psychology of a trader is very strange. You can give somebody a PDF with all the information they need to learn, and they'll still go and buy the next course. I've yet to understand it myself. Somebody said to me today, "Do you ever think the 90%?" Well, he posted in the group. "Do you ever think the 90% will ever change?" I said, "No, it's never going to change. People are too stupid." Do you know what I mean? People are just absolutely buttless. They're just stupid, and you got to accept it. It's part of the cycle. We need these people. Buy your courses. Give your liquidity to the market. If you don't know where the liquidity is, then you are the fucking liquidity. You obviously are. And this is the problem. This is the problem with it. And there's not enough people that will speak properly about it because people want fluff. People want, oh, you want to see my Rolex, you want to see my car, you want to see this, you want to see that. It's stupid. People want to go on YouTube and watch videos of somebody trading a fucking trend line, and it pisses me off so much because there's no need to complicate it. I've sat there for hours trying to learn Wyckoff, Elliott Wavy. I've done all of this. I've learned it all. Right? Did it help me one bit? Did it? Fuck. What am I doing now? Keeping it simple, chilling, sitting back, waiting for a valid trade to come away, and I take it. Got a trade running right now. If you go on my Instagram, you can see it. I've had this trade on since this afternoon. Right? You can see I've already cashed in. If you go on my Instagram, um, obviously, when the podcast is out, you'll still see it. You see, I've shorted GPD JPY today. I've been on short for the past couple of days, breaking my orders up. I did close all by accident, so I had to re-enter. That was yesterday, but the trade's still running. I'm sat here with, you know, smashed my profit target by 3. Got a trade just left there running. I just forget about it half the time. Stops at break even. It hasn't moved as much as it was, but it's probably going to have another big impulsive move for the open. But that's it. I'm chilling. And this is all that the banks do. They're just sitting back, doing paperwork, doing whatever shit they need to do, while the computers are trading for them. We need to trade like them. It's not hard. It's actually quite simple. But people want to overcomplicate it. Why? Because there's something wrong with the psychology of people, what they want to do. People want this instant hit of gratification. Trading's not going to give you that. You know what I mean? Trading's building it up over time. I'm in the journey myself. People don't understand it. People want money now. They want to make the money. They want fast money. They want to come into this thing like it's a joke. Look at the BBC documentary. We were speaking about this earlier. It was a joke. The guys that writ that didn't even know what a prop firm is. They tried to make out like FTMO was something completely different. It's a joke. Forex is a joke. It's adverts on YouTube. It's I'm in my garage here with the fucking bugs and all this shit. And don't skip this video. Oh, I'm in my basement. I teach my fucking gardener to trade. It's just a joke. Do you know what I mean? If you teach your gardener to trade, yes, what the fuck you paying for YouTube adverts teaching me to trade? Get him sat down trading for you on a big account. Do you know what I mean? Do you think I'm fucking stupid that I'm gonna fall for that? Do you know? I mean, no offense. I've brought some shit courses, yeah, because I brought into people personally. But if anybody ever sees an advert like that and buys a course, you need your head checking out because that is just daft. Do you know what I mean? And there's nothing wrong with admitting being daft. We've all been stupid. This is the thing, man. People want sugar coated content. People want all this shit. Just fucking say it how it is. There's nothing wrong with it, But you get shut down, you get cancelled. My views have gone up on the podcast quite a lot, but I expect them to go down because people don't want to know this stuff. People don't want to hear it, and people that do, you know what? Message me. Message me because if you're serious, come and join a team of traders. We're no joke. You know what I mean? We're trying to build a fucking empire of traders that don't give a fuck. That's what we're trying to do, and you know why? Because we don't give a fuck. We just want to make money. That's all we're in this for, is making money for nobody else but ourselves. And this is the key. This is the key to it. You need to not give a fuck. You know what I mean? You need to stay hungry. You need to understand the markets. You need to understand how they move. Forget all this stuff on YouTube. Forget all this stuff on Instagram. It's not gonna get you nowhere. Why would you learn the same as everybody else? Why? Would you do it in other things? You wouldn't, would you? So why do people do it with trading? If you was trying to learn, I don't know, you're trying to learn to be the best. I don't even think of an example like trading. Trading is quite unique, isn't it? You see, because I know if you're trying to learn football, you would go on YouTube, but you know, you wouldn't go and listen to some random guy, would you? So I guess trading's a risk, right? Would you learn how to fucking work a parachute from some random guy in a pub? You wouldn't, would you? You'd go to a trained professional. You know, you wouldn't just go and watch a video and be like, yeah, this guy says it works. I'll buy his parachute. You know what I mean? Because it's a risk. Anything risky needs to be assessed. You need to assess. You know, any people that are familiar with compliance, you do a risk assessment, you assess, you risk. Trading is risky. I know I said that about risk management. I don't believe it needs to be sat there managing it. Manage your profits, define risk, accept your risk. It's that fucking simple. You know what I mean? And this is shit that I've came up with myself. This is nobody's words for that. That is my words, what I say. Because I'm not a dickhead, basically. And this is real talk, man. We're allowed what to say what we want. And this is the thing, right? You gotta look like you gotta look at trading, yeah. Obviously, we're all adults and that, but it is very childish, like the actual industry. The banks don't treat it like this, so why should we be treating like this? You gotta really think into it really deep and think: would a professional trader go on YouTube for tips? If you're doing say, a psychology degree or you're doing a law degree, you're going to go read books. You're going to go and have speak to somebody who's done a master's. Your lecturers are going to be top level people. Why? Because it's a big industry. It takes a long time to learn. It's got some big players in it. Same thing with being a fucking brain surgeon. Yeah, there's probably videos on YouTube, but if you want to know the proper stuff that's going to make you really successful, you just wouldn't be doing it. You just wouldn't be. So why is trading an exception? That he's going to go on YouTube and watch a video, buy somebody's course, ask the question, why are you selling a course for that price if you know how to trade the market? Do you genuinely want to help people? Because if you genuinely want to help people, your price would be not too cheap to make you get a load of dickheads around you, and not too expensive to make it sound stupid, but enough to make you money. So that's obviously a very vast thing, so that makes it very hard to read people, doesn't it? So I guess you've got to be burnt. And I say the same thing, yeah, with trading itself. I believe you've got to have tough skin to be a trader. You've got to, if you're going for funding, you've got to have failed funding a couple of times, at least once. You've got to blow your account, or I've never actually blown an account. But I've lost chunks out of accounts, because I've always fucking probably smashed up my computer before I fucking had a chance to blow the account. But yeah, you have to get burnt because you have to get in with an attitude where it's like, that is my stop loss. I'm putting that trade on and I'm fucking leaving it. I'm not taking my profit today early. I'm leaving it. You want to build wealth. Break the fucking mold, man. Break the mold with this. I don't understand why the industry's so fucked. You know, People want to watch Wolf of Wall Street and think they're a fucking trader. It's mental. If you actually want to watch a good trading film, you want to watch things like The Big Short, Margin Call, Inside Job, Rogue Trader. Those are proper trading films, not Wolf of Wall Street. At the end of the day, people big him up. Yeah, the guy's a fucking criminal. I love him. You know what I mean? I love watching the videos. I love listening to his podcast. But these traders big him up like he's cool. He was a fucking criminal. Do you want to take your fucking trading advice off a criminal? Or do you want to take it off somebody that knows what they're doing? And that right there, ladies and gentlemen, is the problem with retail. That's the psychology of it. They want not Rogue Trader, they want Wall Street, Wolf of Wall Street. That's the problem. They won't read. They'll want shaft books on YouTube, and I fucking hate reading. I love it, but I hate it at the same time. But that's the problem with the psychology of it. So that's it for this episode. Anyway, I really hope you enjoyed it. Real talk, like I say. Um, I believe this episode is not going to go on YouTube. This is just going to go straight onto the Spotify. But you know, let me just break something down. Yeah. So in this, I've shared some research on who controls the market. I've shared some research on who's the best players. Take this information and do what I did with it. Use it to your advantage. You know, now you know who controls. If you didn't know, now you know who controls the market. Now you know what they're trading. Now you know what they're doing, and now we know how they're doing it. How are they doing it? Like I said, using computers. So you instead of spotting patterns and stuff like that, there's patterns as in scenarios that happen. So it's not a candlestick pattern; it's a pattern of events. So it might be a pattern of mitigation. It might be a pattern of continuations. It might be a pattern of going into around certain areas. You know what I mean? That's the little hints I'm going to give you guys that I'm onto. I don't want to say things outright because I don't want people to think it's the fucking holy grail because it's not. I'm fucking learning this stuff myself. So, that's what you need to look at. Not candlestick patterns, but patterns as in scenarios, a pattern of events because they play off every fucking time. But the problem is he's trading them. That's any problem. The patterns always happen, but it depends how far it goes, and you got to get in, and where you're not risking massive amounts. Obviously, you need to get in more refined and precise. But peace out, everyone.